Okay, so today's presentation is going to go over the COVID-19 tax breaks, CARES Act provisions for individuals. Basically, I'm trying to put together here a presentation on anything that I think is related to COVID-19 when it comes to tax, federally speaking, and for the states as well. At the very end of the presentation, I'll try to give you some commentary based on what the states are doing or trying to do, the most recent developments that are going on there, because it's a hodgepodge of activity at the state level. But definitely happy to share my thoughts on the state tax implications based on the remote work for COVID-19. So this is me. I'm the tax director here at the Wolf Group. The Wolf Group's been around for 38 years now. We do international tax. As you can see, I have a variety of international tax practice units that I work in. But with the COVID-19 provisions, I mean, these are going to affect everybody. So it doesn't matter if it's, a domestic U.S. taxpayer or someone with international ties that files a U.S. tax return. You're going to have to kind of understand how the 2020 tax return has changed to deal with some of the COVID provisions, and then even more so planning forward for 2021 as well. Okay, so let's go ahead and just jump right on in. And the first thing that we're going to talk about today are the economic impact payments, otherwise known as EIPs. And the one thing that you have to understand is that there's a checklist for who is eligible for a COVID-19 economic impact payment. Last year, when the economic impact payments were announced, I got a million emails saying, "Do I qualify? Do I qualify? Do I qualify?" It's not as simple as "Do I qualify?" You first have to see, are you eligible even to be considered for a payment, and then from there are certain things that would make you qualify or not qualify. Okay, so to be eligible to get an economic impact payment, you either have to be a U.S. citizen, a lawful permanent resident, or an individual satisfying the substantial presence test in 2020. You cannot be dependent of another taxpayer, including an individual that's passed away in 2020. So some folks may have had that situation occur, and those people would be quote unquote ineligible. And then most importantly, you have to have a valid social security number. And this is an area that I think maybe wasn't followed exactly by the IRS when they were checking the tax returns. So some people may have gotten an economic impact payment that probably shouldn't have. But the way it works is that you must have a social security number or taxpayer identification number where you are eligible for employment inside the United States. And for the economic impact payment to occur, you should have that in place before the due date of the 2019 tax return, including extensions. So in reverse, we have the ineligibles, as they're referred to by the tax code. Ineligibles are typically going to be people that are claimed as dependents on another taxpayer's tax return, which I've talked about. Folks that had ineligible social security numbers, deceased individuals before 2020, states and trusts, and non-resident aliens, which include G4 visa holders. So if you're a G4 visa holder and you received an economic impact payment that was probably improper. Okay, so there are various different versions of economic impact payments. So I'm going to refer to the first version as 1.0 or EIP 1 as the IRS refers to it. These were the checks that were sent at the beginning of April 2020. The determination was that they were going to give single individuals that made between $75,000 to $99,000 of adjusted gross income, $1,200, and then married couples that had $150,000 to $198,000 of adjusted gross income, $2,400. And then for each qualifying child, there was an additional $500 on top of that folks would be eligible for if they qualified for an economic impact payment. The second economic impact payment, or 2.0 or EIP2, was just sent out recently. Some folks may have got this in December 2020. I know that I had a family member that when this was announced, I think he got his deposited a couple days later, and he said, "Oh, it just showed up in my bank account. I got it." So these started going out in December 2020. Some are still being paid out here in 2021. And one of the things that you have to understand is that even if you receive the payment in 2021, it has to be reported on the 2020 tax return. This is very critical to making the 2020 tax return work. So if you've got a second economic impact payment, it doesn't matter if you got that in December of 2020, January of 2021, or even now in February of 2021, you still will need to report that on your tax return here, the 2020 tax return, which the filing season starts tomorrow. We can start e-filing tax returns tomorrow. So make sure that you're taking care about reporting those payments on the 2020 tax return. And the EIP 2.0 payments were $600 for individuals, $1,200 for married couple. And as you can see, the AIG thresholds were reduced for the people getting those, but the qualifying children portion increased by $100. So a little bit of a change on the second EIP payment. Terminology is going to be also critical in regards to how you're telling people, your tax preparers, or working through your tax return if you're going to do it yourself. The payments came across with a lot of different names. So I've been using the term economic impact payment. Some people use the term stimulus payment, stimulus check. There's a stimulus debit card that came through. There's a stimulus credit card. On the 2020 tax return, they're calling it the recovery rebate credit, or that's the term they're going to use to quote unquote true up the payments. So there's a wide variety of ways that the economic impact payment terminology can be used. They all generally mean just about the same thing, but with a little bit of a nuance to it. And typically the way it works is that the economic impact payments are the payments that were determined in April or December, whereas the recovery rebate credit is what you actually should have gotten based on your 2020 adjusted gross income. So let's go over a couple frequently asked questions about the economic impact payments. There are a ton of questions that I'm sure folks have on these, but one question we commonly get is, what if a married couple where one spouse has a valid social security number and one spouse does not have a valid social security number? What happens in that scenario? Well, what should happen is that the one with the valid social security number should receive their half of the economic impact payment, along with any portion for qualifying children. And that's based on the 2019 tax return. The other spouse that does not have the valid SSN should not be getting a payment, even if they have a qualifying child SSN with their portion. And one problem that we're seeing for a lot of folks, if you had to paper file your 2019 tax return, at one point we know, because the IRS was shut down between March 15th and August 1st, we know that the IRS was about 26 million parcels of mail behind, which included a lot of 2019 paper file tax returns. So in some cases, the second payment, which is based off of your 2019 AGI, may not have gone out. And we'll talk about what to do if that has happened. But just be aware that there is that backlog with the IRS. It's not 26 million at the current moment. It's decreased significantly, but there still is a large backlog with the IRS. Okay. Does a child need to have an SSN valid for employment, or will an adoption taxpayer identification number work? So the answer is yes to both. The child needs to have the proper valid SSN or an ATIN. The ATIN is typically what's used for a child that's adopted. Children that have ITINs typically won't qualify for the credits under the economic impact payments. And then a big question that we get asked, we've been asked this since the economic impact payments were first issued. I remember at the beginning, I thought perhaps they could be taxable. Turns out I was wrong. They are definitely not taxable. I think what was great was that, this question that was up in the air for a while at the beginning, the folks that wrote the legislation immediately came out. Chuck Grassley posted on his website, it's not a taxable item. We won't try to claw it back if you shouldn't have got it. Don't worry about it, just take your payment. So it's not a taxable income amount. It's an advanced credit. And we'll talk about how it's trued up on the tax return. But again, it's not taxable by the IRS. It's not taxable by the states. So you don't need to worry about that being clawed back on your 2020 tax return if you, for example, shouldn't have gotten it. Okay. So speaking of the true up, this is where the recovery rebate credit comes into play, otherwise known as the RRC. And what the RRC basically is it's a mathematical formula that trues up what you should have got under EIP1 and EIP2. Remember, the EIP1 was based on your adjusted gross income for 2018 or 2019. EIP2 is based on your adjusted gross income for 2019. The RRC takes a look to see your adjusted gross income for 2020. So, for example, some folks may have had, really great years for 2018 or 2019 where their income was really high. And then maybe due to COVID-19, they lost their job, or for some reason their income dropped significantly. And so the recovery rebate credit will look at that adjusted gross income for 2020, and it will say, hey, should there be a credit offered for this individual that maybe had their adjusted gross income drop, but did not receive EIPs throughout the calendar year for 2020. This is a copy of the recovery rebate credit worksheet. It's not the full worksheet. I couldn't snip the full thing in here and make it work. So this is only a partial portion of the worksheet. But as you can see, it's pretty intricate. It's got a lot of questions and a lot of line items that have to be answered. It's your typical IRS if-then kind of worksheet that walks you through it. I can tell you that I've looked at the tax software, and it's also similarly complicated within the tax software. So there's a lot of opportunities for folks to input the data incorrectly. And it's my opinion that this one area alone by itself will create a lot of IRS math notices or error notices. So if you file your tax return and you get back a math or error notice, hey, we've adjusted your tax return, and you can't understand, why is it adjusting a couple $100 or whatever, it's likely because of the recovery rebate credit was maybe entered in improperly. Okay. So what would you need to do that worksheet correctly to make sure that your tax return is rock solid for 2020? You need documentation. What kind of documentation do you need? So for the first economic impact payment, if you received one, you should have gotten a notice 1444, and you'll need that to input the data for the recovery rebate credit. If you got a second economic impact payment, you either received or should be receiving, and I've yet to see a copy of what one of these look like, but it's notice 1444-B. These notices will give you all of the data points that you will need to enter into your worksheet to get the recovery rebate credit done properly, okay? This is a copy of the notice 1444 all the way on down to the last president's signature down there at the bottom. So you can see it gives you kind of all the things that you need to know to enter in for your economic impact payment and recovery rebate credit. Okay. So a couple questions about the 1444 notices. So what if I received notice 1444 or 1444B in the mail, but never received any actual money? And this has happened to several people lately with the 1444B, but again, I haven't seen what the notice looks like, so I'm not certain as to if it says anything particular about this particular issue. But the IRS guidance is very straightforward, and this is what the IRS will tell you for most direct deposits. You need to wait at least 5 days. You also need to contact your bank that you were expecting the money to go into to make sure that for some reason they aren't holding up the direct deposit, okay? If you're residing in a foreign country, there's going to be a much longer cycle time. I would tell you to wait at least 30 days just to be safe. If after those time periods and after response from your bank, you don't have any good answers, then you can start what's called a refund payment trace, which is typically done on IRS form 3911. It's best though to call into the 1-800 number that I have on the slide here. Have the IRS do the form over the phone for you. You don't necessarily need to sign the form or anything. It can be done over the phone. And they will then try to trace where the payment went to and figure out what happened there. If a check was mailed out and they tell you that it was never cashed, then you're going to want to just do the recovery rebate credit form. If you do the recovery rebate and then maybe you get the check in March or April, you just need to return the check to return to sender, return it back to the US government. And if the check was cashed by someone else that's not you, this was the unfortunate part, then you have to do a claim package, which if anyone's ever had to do that before, they're a little bit painful. but you're required to do that by the Treasury Department. They send you a claim package and you got to fill that out. It's a similar type claim package for folks that have had identity theft and their tax return is not processed because of identity theft or a marker that shows identity theft. It's a similar type package where you just kind of have to prove your identity and who you are. Okay. Okay, so let's see here. How do you know if you get the recovery rebate credit? Well, it's real simple. You go in, you get the worksheet out. You first determine if you're eligible. So you go back to the beginning of the presentation and work your way through the eligibility slides. Determine if you were issued the EIP 1 or 2. You should have gotten the notice 1444 or 1444B. If you were eligible and you did not get EIP 1 or 2, then you should get the recovery rebate credit. If you were eligible and you got EIP 1 or 2, but it's less than the number that the credit comes out to, then you get the difference. If it's more than what the credit tells you, then no harm, no foul. You don't have to pay it back. You just don't get a credit. Okay, so let's do an example, and we're going to go to our good friends Bonnie and Clyde. This is actually a slide created by one of our associates for internal training. I thought it was pretty funny, so I borrowed it for this presentation. But Bonnie and Clyde are U.S. citizens, so this is going to be our hypothetical example. They have no children. They file married filing jointly. Their AGI in 2018 was 176, 2019, 200,000. They did not receive any economic impact payments in calendar year 2020. Bonnie and Clyde had a really bad year in 2020. They didn't rob enough banks. And so their adjusted gross income dropped to 160 for 2020, okay? So their recovery rebate credit is calculated as follows. They made 160,000, that's their adjusted gross income for 2020. There's a threshold that's the limitation starts at 150,000. So they have to reduce their credit by 5%. So it's basically $500 reduction because their income is $10,000 over 150. And so for the first economic impact payment, they should have gotten $1,900, okay? For the second economic impact payment, EIP, they should have gotten $700. There's that second reduction as well there. And so when you add those two payments that they should have gotten, they will get a credit, a refundable credit for $2,600 on their 2020 tax return. And that's typically how the math goes if you did not receive a payment, but you should have. And again, if you received a payment, but it's less than what this actual calculation turned out to be, so let's say that Bonnie and Clyde received $2,000 total in economic impact payments, then they get the difference. They'll get a $600 credit on their 2020 tax return. If you look on the tax return, the recovery rebate credit is going to be line 30. And so you can clearly see that it tells you to go see the instructions and you got to go complete the worksheet, et cetera. But that's a new line item on the 2020 tax return. Okay. There is a third economic impact payment that is being proposed. I'm sure you guys are seeing this all over the news. President Biden has the $1.9 trillion package in the works, excuse me. $1,400 of payments to qualifying individuals, $2,800 of payments to married couples. That is still being contested. Some folks don't want those payments to be that high. They're trying to mitigate those payments downward. The other part is that under the Biden tax plan, which has a lot of moving parts, one of the things that the Biden tax plan wants to do is increase the child tax credit, which is currently $2,000 right now, to $3,000 per child. And then if the child's under 6, you get an additional $600. And so instead of trying to push all of that through budget reconciliation or a comprehensive tax legislation package, they're trying to include just that portion in the current stimulus package, the $1.9 trillion stimulus package. So trying to segment bits and pieces of what the Biden tax plan is trying to do within other packages as well. And there's a couple other things that they were trying to push through as well, some changes to international corporate tax provisions and things like that. Whether those things will actually survive to the end product is an unknown, but this is basically the nuts and bolts of the big tax changes that they're trying to do. It's doubtful that the 3.0 payments would be reportable on the 2020 tax return, but the commissioner has said that one of the reasons that the tax season was delayed until this Friday, because normally it opens in mid to late January, is because of the second round of payments. The second round of payments caused the IRS to have to go back and retest the 2020 tax return to input those, which delayed the filing season from starting. And if a third round comes out, they may have to push back the filing deadline, currently April 15th, to a deadline later. So we'll have to wait and see how this plays out over the next week or two, or however long it takes for them to finalize this legislation. But it's something that everyone should keep an eye on for EIP 3.0. Okay, a couple other things that are not related to economic impact payments, but definitely may be applicable. So we have a lot of clients that are on assignment abroad, US citizens, perhaps green card holders that have permission or whatnot. They're typically using what's called the foreign earned income exclusion to reduce or offset their wages or their earned income. And perhaps they were working in their foreign country or their non-US country and forced to return back to the United States. If they were forced to do that, they may still be able to qualify for the foreign earned income exclusion, but they would need to use Revenue Procedure 2020-27. And the procedure basically says that the days that when you're back in the US do not impact the test for the foreign earned income exclusion. However, it would be only the income you earned abroad that would count towards the foreign income item. So again, there's a couple things that you have to walk through to be able to use 2020-27, and there's some limitations to it. This is a revenue procedure, though, that I think is ripe for updating, and perhaps the IRS may come out with a second version or an updated version to provide more relief and maybe allow more income to be excluded. And so here's an example of basically how the revenue procedure would work. So we have Jane. She starts her foreign assignment that, she's supposed to basically do a 3-year assignment starting on January 15th, 2020. She in Italy. Due to the lockdown, though, she's forced to return back to Los Angeles on March 31st, 2020. Her 2020 wages were $120,000. She originally planned to work and spend the full year in Europe, returning only to the US for a 2-week holiday. Therefore, her intended days of presence outside of the US, and again, we use a slide rule here to add in the additional 15 days prior to moving to Italy and the 14 days of vacation. So you have 348 total days outside of the US. This is obviously greater than the 330 days for the physical presence test, and therefore she would qualify for the foreign earned income exclusion under RevProc 2020-27. But her actual work days were only 74 days. So it's only the 74 days of allocation that we use for the test. And so you can see here, there's a limitation of down to 54 work days. We do the allocation of 54 work days divided by 250 total work days for 2020, and we can exclude 25,920 of her salary under the foreign earned income exclusion. So like I said, there's going to have to be a lot of calculations and thought that goes into how this will work on the 2020 tax return. If this happened to you during 2020, it's not going to be simple. It's not going to be straightforward. And I would tell everybody, give yourself some grace, give your tax preparers some grace. It's not going to be as easy as it was, say, in prior years. Okay. There's also a host of other things that are still unanswered, and that's why I think there's going to be an update to RevProc 2020-27. It's unknown. For example, if you signed a lease for an apartment, let's say Jane signs a lease in an apartment in Italy, and she can't get out of it, so she had to pay on the lease for the entire year. Could you claim all of those housing expenses? That's still kind of up in the air. If foreign taxes were paid, could you possibly switch in and out of the foreign tax credit and take that instead of the foreign income exclusion without losing the ability to do the exclusion for 5 years? Because under the current rules, you can't flip back and forth between the two. You can use both of them concurrently, but if you try to flip back and forth between foreign income exclusion and foreign tax credit exclusively, you lose the ability to take the foreign earned income exclusion for 5 years once it's revoked. So there may need to be a little bit more grace by the IRS on the ability to do that. There's absolutely no mention about social taxes or totalization agreements. And then obviously there's all sorts of costs with benefits. that are occurring overseas that are not being contemplated as well. Now let's do the reverse situation. Let's say that you are a non-US person and you were forced to stay in the United States. So you came to the United States for some reason. You then were forced to stay due to the quarantine. Well, we have another revenue procedure, 2020-20, that basically says that for purposes of the substantial presence test, we would not count the 60 calendar days between February 1st and April 1st. You can also, use the closer connection exception. There's a wide variety of ways that you can basically continue to be a non-resident under this procedure or the general closer connection exception rules and tax treaty rules. So there's different ways to slice the cat on this one. And again, this is one of those things where you kind of have to do the pre-analysis, bake everything out, make sure you understand the approach before you do it. It's going to be very difficult to try to shotgun this while preparing a tax return within the next 60 days by the due date. So really you should take your time, perhaps file an extension if this is an issue that you're going to be dealing with, because it's not going to be a straightforward answer as to how this is going to be treated. It's going to take a lot of time to understand the way that this should be put out. Some other things to contemplate here. There were changes to charitable contributions starting with tax year 2020. And so the normal limit for charitable contributions is 60% of AGI. That actually is an increase under the Tax Cuts and Jobs Act. However, for 2020 and for 2021, there's an increase where you can take charitable contributions up to 100% of AGI, which is huge. It's got to be cash contributions, and you can't give any contributions to donor advised funds. So we've had a lot of people do year-end tax planning where they are doing charitable contributions to get into the 100% AGI bracket, to take advantage of that in 2020. And I would tell you that if you want to do charitable contribution planning for 2021, it's going to be a great time to do that. You can take a look at your 2020 tax return once it's complete and see if perhaps you want to do some charitable planning for 2021 to take advantage of this increased limit. If you are not itemizing your deductions, so the first part is for those folks that are itemizing. If you don't itemize, well, you're okay too. You can still get $300 if you're single, or $600, or actually it's $300 total for everybody for 2020. And then I guess they're flipping it to $600 for married filing jointly in 2021. It is now going to be an above the line deduction for those folks that don't itemize. So you can still take advantage of some charitable contributions if you take the standard deduction. And again, there's your above the line standard deduction for charitable contributions on page 1 of the tax return. Brand new for the 2020 tax return. Okay, common question that we get from a lot of people. All of us have been forced to work from home, and I get a lot of my friends are asking me, hey, I've had to take, one of our spare bedrooms and convert it into an office. We've had to do a little bit of remodeling on that, maybe put some, lighting in there, or, run a connection for the computer or whatever it is. I've had to make changes. Can I deduct that? Can I take a home office deduction? And the answer is it really depends on what type of work you're doing. So much to our dismay, Congress has not made any changes to the home office deduction, which I think is a really bad move, right? I mean, a lot of us have been forced to bear the brunt of our employers, what our employers normally pay for by working from home. And so no changes to the home office deduction are not helpful. And so the first thing to note is that if you're an employee, you're not eligible to take the home office deduction, okay? That makes you completely ineligible. So any modifications you did to your house to do a home office during the pandemic are not something that you're going to be able to write off on your tax return. The home office deduction only applies to individuals that are self-employed. Consultants are a good example of that. And typically the home office deduction is going to be reported on Form 8829, and it's going to coincide with Schedule C. So that's how you know if you can take the home office deduction. You can take it regardless of whether you own the home or you're a renter. It must be your principal place of business, so it's where you're exclusively working. So for most people that were self-employed for 2020, that's likely going to qualify. And it's got to be an exclusive portion of the house, which means you can't call your living room. So if you just sit in your living room and you're working, Obviously, that's a living room where other people are going to use that portion. It has to be an exclusive portion of the home. Prior to the pandemic, a lot of people typically use what's called the simplified option, which gives you a maximum deduction of $1,500. Basically, just measure your home and see what the options are from there. The non-simplified version is a little bit more intense because you have to look at the various bills that you're paying for the home and then take a proportion of that. It's also something that can be highly audited by the IRS. So as the saying goes, pigs get fat, hogs get slaughtered. So I've seen some people that have gone to town by including all sorts of repairs and maintenance that have nothing to do with their home office under the non-simplified method. And you get caught doing that and you get audited. You'll lose, and then you're gonna have more gross income, more tax and penalties. So be real careful with the home office deduction and make sure that you're working with someone that understands how this works if you're going to use the non-simplified method. Okay, we did a presentation on this last year on the CARES Act, and that is available on the YouTube, the Wolf Group YouTube channel. But just as a reminder, the CARES Act basically allowed for some temporary reliefs for 2020 only. So again, you can withdraw $100,000 from your retirement account, penalty free, but you'll still owe the tax on that withdrawal. So if you need some quick cash in 2020 to supplement you, and you took that drawdown of the retirement plan, the penalty will not apply. The early withdrawal penalty will not apply, but you'll still be subject to the income tax. You can pay the amounts back for 3 years and avoid taxation altogether. So you basically, you have to take a close look at whether or not you're going to pay back the money or not, and whether or not you're going to spread it out over a 3-year period. So there may be some decision making that you need to do with your tax preparer on this particular thing, on this particular withdrawal. And then for RMDs, the rules changed obviously from 70.5 to 72. And so again, if you were set to take a required minimum distribution in 2020 and push that back under the new rules, then you just want to make sure that you do that under the new age limit that the IRS has under the CARES Act. Social Security tax deferral. So in some cases, some folks that were self-employed or maybe had nannies under Schedule H decided to defer the payment of the employer portion of the tax. As you can see on Schedule 3 here, there's now a line item for the deferral of that tax. If you did that, then you definitely want to make sure that you're putting that down there. And there's going to have to be a repayment of that, obviously, at a certain point in time. But there is the deferral of those employer portions of the tax, or 50% of the Social Security tax, for Schedule SE and for Schedule H. And if you chose to do that, then that has to be reported in this section here under Part 2 of Schedule 3. For the self-employed individuals, you see here that there's this new part of Schedule SE, so it's Part 3 now, where it allows self-employed persons to figure out the amount of deferral that they can take. And as you can see at the bottom here, half of the deferral amount is due by the end of 2021. The other half is due by the end of 2022. So there are some ways to go about deferring taxation of the self-employment taxes on the tax return for 2020. Again, if this is something that you'd like to have done, you just need to make sure to talk it through and walk it through with your tax preparer to make sure that it's input properly. Schedule H, again, just kind of pointing out here that the form has not been finalized as of yet. As of today, I don't believe there's a final form yet. And there's no instructions yet on exactly what to do within the Schedule H to make the deferral work. So this is still kind of one of those forms that's up in the air. And for those folks that fall into this category, your tax return may be delayed from filing until the form has been fully finalized by the IRS. For certain individuals that are self-employed and perhaps had to take some leave from being self-employed, you can file the 7202 to get a tax credit if you took leave to take care of a sick family member. That was under the Emergency Paid Sick Leave Act. So if you did have the situation where you were self-employed and you were working and for some reason you had to stop working to take care of a family member, perhaps for COVID-19, you could qualify for a credit, and you would just need to complete this Form 7202 to take that credit. Net operating losses. So this is another change that has come through. So some folks may have incurred net operating losses in prior years or in 2020. The 2020 tax return basically tells you that you have a decision to make. You can either carry back your net operating loss to the prior 5 years, or you can make an election just to carry it forward, starting with 2020. And so it's very important that you sit down and you take a look at the previous 5 years to see if there is an impact to carrying it backward, or if you should make the election to carry it forward. We just did this with a client at the end of 2020, and it's a pretty straightforward process. You just complete, I believe for him, we did the Form 1045. We took a look at the change of tax and what the refunds were for the 5 years going backward. And we'll make the election, obviously, to carry back on the 2020 tax return. But again, if you have a net operating loss on your tax return, then you do need to kind of, again, it's another decision point that you have to sit down with your tax return preparer and determine the best way to treat that net operating loss for the 2020 tax return. A couple other changes, and I think these are good changes. I think the IRS is definitely moving in the right direction by making these changes. They came out with what's called the Taxpayer First Act, which is basically trying to help taxpayers, work with tax professionals and the IRS. It helps taxpayers sign documents electronically, submit things electronically. That way, people don't have to interact, and it minimizes the risk of COVID transmission. So I think these are all great moves in the right direction. This summer, the IRS is planning to launch this new Tax Pro account, which should help speed up the transmission of documentation between a taxpayer and their designated representative. We'll see how that all plays out. But for example, certain forms that could be e-filed last year were the 3520, the 3520A. If you had an estate return or a gift return, those could have been e-signed as well. So definitely something that I think we're keeping an eye out for, and we're hoping that not only can you e-sign these, but perhaps maybe e-file them very soon. For those folks that have to file the 3520 and 3520A, they know the pain of having to mail those forms in throughout the year, and they can be very painful as far as how to do it, the process to do it. I think it's a lot easier if the IRS were just to allow these forms to be e-filed. Unreimbursed educator expenses. So I don't know if anyone is a teacher or has a teacher in their family. I know that my mother-in-law is a teacher, and when this came out, I immediately told her about it. But if educators, out of their own pocket had to buy face masks, disinfectant, hand soap, gloves, whatever it was to assist with their job as a teacher, you can use those expenses as a deduction. It's an above-the-line deduction on the 2020 tax return. And if you want to learn more about what does qualify, you can take a look at RevProc 2021-15. It kind of walks you through all the different rules and things that are allowable. It's generally, though, a deduction of up to $250 for an individual and $500 for a married couple, but both people have to be educators to make the $500 work. Due to the pandemic, the National Taxpayer Advocate has basically been overwhelmed with cases and with people coming through with all sorts of negative experiences with the IRS, whether it's penalties being received or notices coming out of the blue or tax returns not being processed. There's all sorts of issues that the pandemic has kind of surfaced with taxpayers. The Taxpayer Advocate hears a lot of them, and so they kind of do a reconciliation every year, and they make recommendations to Congress for ways to update the IRS or to fix client service with taxpayers. And as you can see, their top recommendation always is give the IRS more funding. And if you'd asked me, should the IRS get more funding 10 years ago, I probably would have said no. But now I'm clearly a proponent. Imagine operating a business with your 2010 operating budget. That's basically what the IRS is trying to do. They basically have not gotten any funding for over a decade to increase their budget, and that's a shame. They really do need to have more funding to make their systems work. And I would be an advocate of them getting some dollars from Congress to update their systems. Some other cool things that the taxpayer advocate has mentioned here is basically changing the estimated tax payment deadlines, eliminating duplicative reporting with the FBAR and the 8938. For folks that do both of those, there's a lot of duplicative reporting that occurs on both forms, and it's not necessary, to be honest with you. And so eliminating that would be great. For folks that are bona fide residents of foreign countries, excluding those folks from reporting on the FBAR and 8938 altogether, I think would be a huge step forward. Allowing non-resident aliens to use the standard deduction, which currently non-resident aliens, typically for the clients that we speak to, the G4s, you can't use the standard deduction, you have to itemize. So perhaps allowing them to use the standard deduction. Changing the estimated tax penalty from a penalty to a full interest charge. So right now it's the penalty plus interest, and just kind of converting that to just an interest charge. Modifying definitions of willful, and I think there's also a modification of the non-willful definition for FBAR violations, I think would be great. And then last but not least, creating a position within the IRS called IRS historian, which is, I'll be honest with you, that'd be a job I would love to do once I retire. I'd be happy to be the IRS historian and take over that position with them. But I think that's a cool position, in any government entity. Okay, so we're close to the end here. This presentation is probably not going to go the full hour. I will answer some questions though. It looks like we've got about 11 questions right now, and I'll try to answer those. But first, let's talk about state taxation, because I think this is going to affect a lot of people. And I want to warn you that for this tax year, you may end up with two or three different state tax returns. That you could have, a couple states that you're a non-resident in, a couple states that you're resident in. You have to be very careful with how the state tax returns are going to be. And once again, please give whoever's doing your tax return a little bit of grace with these issues, because it's a moving target and all the states are different on how they approach their taxation for 2020. And it's an evolving area of legislation, both at the state level and at the federal level. So again, just pay close attention to what's going on with your state or states if you are working in multiple states. So right now we have 41 states that have some kind of income tax on employment income. As I said, each of them have their own rules. They have their own rules on what happens when you are a resident of one state and you are working in another state. There is no uniform standard throughout the states. There have been drafts of legislation that have been brought up but have failed to create some kind of uniform reporting between the states. During the pandemic, we now know that about 1 in 5 adult Americans had to relocate. So perhaps you were working in one state and then you were living in another state and you had to relocate to a home office in the state that you live in. So you were no longer working in the state that you normally travel to. Or perhaps you moved. Perhaps you had to move from the state you were in to another state for a variety of reasons. But a lot of people basically had to change their mode of operation when it came to working. We call that remote working or teleworking. And there's basically three approaches to this when it comes to the states. And you have to look closely to how the different states interact. So the first approach is reciprocity. So there can be some agreements between states that say, hey, we're going to work together to make sure that folks can work in our state but live in your state, and they're not being double taxed by doing that. So for example, New Jersey and Pennsylvania have a really good reciprocity agreement to make sure that if, say, someone in Pennsylvania is working in New Jersey but living in Pennsylvania, that they don't get taxed in both states. Some states will offer a credit for taxes paid to another state for employment income. So tax credits are a good way to resolve issues between states. And then some states, and this is an unfortunate take that some states have, it's called convenience of the employer, which basically says, we don't really care where you're working. If your employer is in, Massachusetts or New York, then Massachusetts or New York is going to tax you for your income. It doesn't matter if you're working in New Hampshire or Connecticut or New Jersey. It only matters if, for example, you were working for a company in New York, but you were working for a company in New York for a project that can only take place in, say, Delaware, right? Then, if you're in Delaware doing that project because you have to be there, then that's different. But if you're in Delaware just because that's easier for you, but your business is in New York, then you probably have to pay New York tax. And so that's where the convenience of employer rules come into play. Okay. So again, if you see this map here, you see that the different types of states that haven't announced relief. Some states have said that they won't tax their workers. There's all sorts of different takes on what states are going to do the changes to their rules and which ones aren't going to do changes to their rules. We have this slide right here that shows the different remote worker thresholds. So sometimes folks will come to me and say, hey, I went to California for 10 days. I had 10 days of work there. Do I need to actually file a tax return? And when you look at their income, it's like, yeah, 10 days, even 5 days or 2 days, you may have to file a non-resident return in California. So depending on where you were and the work you were doing, you may have multiple state filings that have to go down. And so let's go through an example of a common situation that we see. So we have Jane, whose usual home is in New York. Her employer is in Manhattan, but she's living at her weekend home in Connecticut during the pandemic and expects to be there more than 6 months this year. Jane's permanent home is still in New York City, so she's still going to owe New York City tax and New York state tax on the income she earned while in Connecticut. Connecticut will also tax her because she's going to be in Connecticut for more than 183 days. In this situation, you now have someone that's basically a resident of 2 different states, and there currently is no mechanism to do a credit between these 2 states at the moment. Okay, so this may lead to Jane being double taxed by Connecticut and New York. So what happened today is Connecticut knows this is a problem. And they're basically saying, well, if New York's not going to do anything about it because they have their convenience of employer rules, then we will introduce a credit. So Jane potentially could now take a credit for the taxes paid in New York against the tax due in Connecticut to resolve the issue of double taxation between the 2 states. Hopefully this bill will pass before we get too deep into the filing season, because right now there's really no relief for Jane whatsoever. And I think we also saw this several times with folks that maybe were normally living in New York City and then they moved out of the city for the pandemic. There was a lot of executives that went to their house in the Hamptons, so they weren't living in New York City for most of 2020. The city is still coming after them for taxes, even though they were out in the Hamptons for most of 2020 and saying, hey, it doesn't matter. You were normally working in the city, your business is in the city, you owe us the city taxes. So this is a common problem that we're seeing for a lot of states right now. Let's go to another situation here. So we have Mr. Schwarzenegger is a California resident, obviously, working for a California company, but he's decided to go to his brother's house in Phoenix. His brother has the weight room in the Mirror. He's going to be working in Phoenix while he's at his brother's house. So he will owe Arizona for taxes, but he'll also potentially owe California as well. California is super aggressive on their tax base. They need the money. Being in California is kind of like being in The Godfather. You think you're out and they pull you back in. However, California should be giving a credit to any taxes paid in Arizona, and that should be reflected on the W-2 for Arnold. But again, not a clear understanding if that will actually come to fruition or not. So you have another example here of 2 states that are basically wrangling over income that is being double taxed in 2 different states based on pandemic and location. Okay. And then last but not least is reciprocity. And as you can see, the states in green have reciprocity agreements. The states that aren't in green do not have reciprocity agreements. A common example of reciprocity is Virginia and DC. So we have a lot of folks that live in Virginia. They normally commute to DC for work. There is a reciprocity agreement between the 2 jurisdictions that basically says, hey, DC is not going, they're going to make sure that, DC and Virginia are going to work out who's going to tax the income and that there won't be a double taxation event occurring at that point in time based on the reciprocity agreement of those two jurisdictions. And then last but not least, we have what's going on at the federal level. We have the Supreme Court case of New Hampshire versus Massachusetts. So again, Massachusetts is just like New York. It basically says, we don't care where you're living. If you're working for a Massachusetts-based company, and that's what you were doing before the pandemic, then we want our tax revenue. You need to pay tax to us. New Hampshire is saying, hey, hold on a second. That can't be because they're living in New Hampshire. So we've got a lot of states arguing over this. It's currently with the Supreme Court, and the case will determine the convenience of employer rules, and we'll see how that plays out. But that's what we're currently waiting to be decided. And that's the end of the presentation for the COVID rules. We got about 9 minutes left, so I'm going to go through a couple of the questions that we received, and then we'll call it a day here. Okay, so I still have not received my recovery rebate credit. So on that one, what I would tell you is that the recovery rebate credit is part of the 2020 tax return. So obviously you would not have received that yet. I believe what this person is referring to is their economic impact payment. If you didn't receive either the first or second economic impact payment, but believe you should have, then you need to do the recovery rebate credit on the 2020 tax return, which can start with filing tomorrow. So make sure that you do that, okay? If a G4 visa dependent has received some payments during COVID, what needs to be done in order to avoid risky consequences later? If you received a payment but shouldn't have, there are ways to return the payment. You can go on irs.gov to see how to return the payment. Alternatively, I think you can potentially donate the payment to charity. That could be a good move to do. But you first want to check out the rules on the IRS website about someone that's received an improper payment. Okay, let's see here. Okay, I'm retired and a green card holder. My wife has a G4 visa. We have some savings which generate small income. Does she have to declare those? If not, should I have to declare it? That's a very, very specific question. And I'd probably have to know more to answer that. But typically, let's say that you have a G4 visa holder that has a bank account that generates interest income. That's not going to be taxable to the G4 visa holder because of the portfolio interest exemption. In fact, most interest income isn't taxable to G4 visa holders. So I'm not sure if that answers the question, but I think you have to look at the facts and circumstances to determine, but sounds like probably not a taxable event. Okay, so EIP1 taxpayers with SSN who filed married filing joint with a spouse with an I-10 were ineligible. That changed with EIP2. Is that retroactive to EIP1? Can EIP1 be claimed via the recovery rebate credit for 2020? Yes, it may be. Again, the recovery rebate credit is a true up. It's basically the final true up of what should have happened, because the IRS knows that all the payments that were sent out could have been somewhat incorrect. So definitely you need to work through the recovery rebate credit worksheet to make sure that if you were due to get one of those payments but didn't get it, that you do get it as a credit on your 2020 tax return. I'm eligible for the recovery rebate credit or for the economic impact payment, but I never received the payment or the letter. What can I do? And again, it's very clear. You do the recovery rebate credit on the 2020 tax return. That should be your next step. What should I do if I have not received the notice 1444 or 1444B? Well, again, not having that notice isn't necessarily detrimental, but you could input the improper data points into the recovery rebate credit worksheet, and that could lead to some sort of error when you file your tax return, which isn't the worst thing that can happen. I mean, the IRS will adjust the tax return for you to whatever it properly should be. But typically those notices are going to be very handy to doing the recovery rebate credit worksheet. And so if you can find those, then that's very helpful. If you don't get them, then you'll have to use whatever information you have available to drive that worksheet and try to get to the closest possible answer. Okay, for a G4 visa holder filing 1040-NR for reporting rental property, can I benefit from the home office deduction? The answer is no, you cannot benefit from the home office deduction. Is the World Bank pension required to be filed on Form 8938? That's not really a question for this particular presentation, but for certain folks that are green card holders and U.S. citizens, the World Bank pension may be required to be filed on Form 8938. Again, that's a facts and circumstances test that you have to look at. On one of the slides, it says that there's a recommendation that the taxpayer advocate says to use the standard deduction for non-resident aliens. Is this for G4 visa holders too? Yes, most G4 visa holders, as long as they're full-time employees of an international organization or a spouse or dependent of a full-time employee of an international organization, will be considered non-residents for US tax purposes. Current non-residents can only itemize, they can't use the standard deduction. And so the taxpayer advocate is basically recommending that that be changed so that non-residents, whether they're G4 visa holders, true non-residents, or other visa holders like the G1, A1, A2, can use the standard deduction if they have a filing requirement. Should one be worried if one's 2019 federal return has not yet been processed? Yes, I think so. And I guess it really depends on when you sent it in. If you mailed the return in March or April of 2020, then yeah, that's a long, long time. You probably want to look into that and see where the return is at. And I would tell anybody that if you have to mail in a tax return for 2020, my advice is always to mail it with a check for $1, even if you have a refund. The reason is because the IRS will always cash the check for $1, and they will code your master file 2020 account that says, tax return received, payment with $1. That always goes on there. And then you can point to that and say, aha, you got my tax return, but it's not yet been processed. Where is it? Please process it. If you don't do that, then sometimes the tax return can float in limbo until someone picks it up. And then if it's misprocessed, there's really not a code that's ever put on the master account. So I always recommend, if you have to paper file, which hopefully you do not, send it in with a check for $1. Okay, I was late and haven't filed my 2019 tax return, therefore I haven't received any IRS checks. I should not have a problem getting my economic impact payment by filing now. Well, okay, so first off, you do need to file your 2019 tax return. I'm required to tell you that. You should get that in. You should not have any non-filed tax returns. So I would highly advise you file 2019 as soon as possible. When you file your 2020, that's, again, it's a true up. The way the law works is that it's really the end result is what was your 2020 AGI, and that will tell you your economic or your recovery rebate credit on the economic impact payments that you should have gotten. So if you did receive any EIPs, perhaps because you didn't have a tax return on file, then you definitely need to file your 2020 tax return and do the recovery rebate credit. Will your recording be available to us via link? This is such a great presentation. Well, thank you. I appreciate that. Yes, it will. It should be available to you, I'm hoping next week. It really depends on how quickly our support team can get everything put together and distributed out to everybody. We're right in the middle of starting our tax season, so it's always a Herculean effort. Our support team led by Yolanda Medina does such a great job, though. I'm sure that they will get it out to you guys next week. What about traveling nurses for the two-state dilemma? Yes, traveling nurses, they may have a couple of different states depending on where they worked at. So I think it's important that you keep a calendar of all the states you were in. We obviously will know your income for the entire calendar year. We'll have to apportion that income, and then we'll have to determine, likely you're gonna have one state that you're a resident of, but then several non-resident states that will need to be considered as well. Will the IRS have an online option to confirm the EIP amounts? I'm not sure that there's an online option that confirms the amounts, but the recovery rebate credit worksheet should do that for you. And you should take a look at that worksheet, because that really is, again, it's the true up. It's the final say on what you should have got. My bank lost my EIP-1 check. What do I need to do to still receive the RRC? You need to file. You need to file that 2020 tax return, and basically act as if you never got the money, and then let the recovery rebate credit do the work. But if the bank lost the check, I think you also want to notify the IRS maybe on that refund trace as well. I think that's probably a pretty good option there. Further to the question on the 2019 federal tax return has not been processed. The full payment was made in April 2020. I've stamped date return receipts to the US Postal Service. They also called and they said they haven't received it. Well, there's a couple of different things you can do there. We actually have a blog post, because this is, you're one of hundreds of people that are thousands of people that have, maybe even more than that, that have the same problem of not having a tax return process. You definitely want to keep contacting the IRS. As they say, the squeaky wheel gets the oil. If you don't really have the time to do that, you can hire someone to do that at the Wolf Group. We typically engage people by doing the form 2848. We'll call in on your behalf. We'll check on it. If it's a really serious matter and it's going to cause you an economic harm or impact, then perhaps we might want to try to open up a taxpayer advocate case and have the taxpayer advocate look into the matter for you to try to get the return processed. What we do know, though, is that you should not send down a second tax. You should resend the tax return in. That's actually a bad move to do. So you kind of have to work the angles to push the ball. We have a client that I actually said, maybe we might want to send in a second tax return, and literally the next day the client came back and said, hey, it finally processed. So again, I think we have to stick to our guns and say, we're going to trust the system. We just kind of keep pushing the matter forward. Let's not forget about it. And the longer it takes to process and the more harm that comes your way on it, the more likelihood that you probably need to get it in front of the taxpayer advocate to get the issue resolved. Okay, so this is all. We're about 2 minutes over, so I'm going to go ahead and put an end to the presentation now. There are a couple questions that weren't answered. I will make sure to follow up with the folks either directly on those questions, or I will publish the answers to the questions with the materials, and hopefully you guys will get all the information from the presentation to you next week. I do appreciate your attendance, and we will be having another session, a 2020 tax return update. I believe that's in 2 weeks on Thursday, the 18th. I believe that's when we're doing the next one. And that should be a good one too. We're going to go over all the changes, outside of the COVID stuff, all the things to expect and all the changes for the 2020 tax return. So again, I appreciate your attendance, and we look forward to seeing you at the next Wolf Group webinar. Thank you.